Okay, so we've got some really interesting stuff you shared with us on personal account dealing, PAD, right, and
That's
finance.
right.
And look, your first reaction might be, okay, this sounds like internal company stuff, really technical, maybe doesn't affect me.
Yeah, a bit niche perhaps.
But honestly, stick with us because as we unpack this, I think you'll really see why the rules around this, well, they actually matter to everyone in the financial system, even if you don't trade yourself.
Absolutely.
Yep.
So personal account dealing, PAD,
Yeah.
uh, at its heart, it's, pretty simple. It's just when people working in financial services trade or invest using their own money
Hmm.
for personal gain.
Right.
And that FinCrime intelligence piece you mentioned, it highlights there are, well, pretty clear rules about reporting these trades. And the main point, it's all about preventing conflicts of interest,
Yeah.
stopping things like insider trading before they even start.
Okay. Okay. Let's dig into that. Why is it such a, well, a sensitive thing? It's just their own money, right? Why the big deal?
Well, the core issue, it's a really significant conflict of interest. Just think about it.
Go ahead.
People inside financial firms, they often see confidential information, right? Stuff that can move prices before it's public knowledge.
Ah, okay. The inside track.
Exactly.
Mm.
And that creates this, well, this huge temptation, doesn't it? To use that info to make a quick buck for themselves.
Yeah.
It's like knowing the race results before the bets are closed.
Right, right. I can definitely see how that gets messy. So, what kind of specific problems are we talking about? What are the real risks here?
So the article mentions a few key ones. Insider trading is the big one, obviously,
Yeah.
using that non-public info for profit.
Mm-hmm.
But there's also something called front running. Imagine a firm's about to execute a huge buy order for a client, one that'll likely push the stock price up.
Okay.
An employee who knows this might quickly buy some shares before that client order goes through, then sell after the price jumps.
Ah, so they're basically cutting in line, using the client's move to profit themselves.
Exactly. Potentially at the client's expense, even. And then there's also the risk of employees misusing the firm's own research or their, fancy prediction tools, proprietary models, they call them,
Oh.
or even just knowing what big positions clients hold, using all that knowledge to guide their own personal trades.
Wow. Okay, so it's not just like blatant insider trading, but also these slightly grayer areas, taking unfair advantage of their position.
Precisely. And this is a really crucial point the article makes. Even just the perception, the appearance of improper dealing can be incredibly damaging.
How so?
Think about a restaurant. If there are rumors the kitchen isn't clean, even if it's not true,
Mm.
people lose trust. They go elsewhere.
Yeah, makes sense.
It's the same for financial firms. If clients even suspect their advisor might be putting their own trades first, that trust, which is absolutely fundamental in finance, it just, poof, disappears.
Completely. You have to trust they're acting in your best interest if they're handling your money. So who's making sure this doesn't happen? Who are the watchdogs?
That's where the regulators step in.
Yeah,
The article names some big ones globally. The SCA in the UK,
right.
the SEC in the US, ESMA over in Europe, and MAS in Singapore. It really shows this isn't just a local issue. It's a worldwide concern for market fairness.
So it's a global standard, really. What are these regulators actually demanding from firms? What are the sort of baseline requirements?
Well, there are several common threads.
Oh.
First, firms absolutely need clear written PAD policies.
Yeah.
No ambiguity.
Okay.
These usually demand pre-trade approval for certain types of trades. So, asking permission before you trade.
Right, a check.
You also see restricted lists of stocks employees can't trade, maybe because the firm has inside info, and blackout periods, say, around earnings announcements.
Got it. No trading sensitive stuff at sensitive times.
Exactly. And critically, firms have to record personal trades, actively monitor them for anything suspicious, and review those records. Plus, mandatory staff training. Everyone needs to know the rules and, importantly, why they exist.
And if a firm or employee just ignores all this, what happens then?
Oh, the consequences can be pretty severe. The article mentions significant fines for the firm, formal enforcement actions, which really hurt reputations,
Right.
and internal discipline for the employees involved.
Yeah.
That could easily mean losing their job. So, yeah, there are real teeth to these regulations.
Okay, so the regulators set the floor. But what are the really good firms doing? The ones trying to, properly get a grip on this, not just tick the boxes.
Yeah, the article talks about best practices, going beyond the minimum. It emphasizes having strong governance and monitoring frameworks.
Okay, what does that actually mean in practice?
It includes things like those pre-trade approvals we mentioned, getting that explicit okay before certain trades, especially if it involves securities the firm deals in for clients. It's kind of built-in pause for thought.
Like a safety check before pulling the trigger. Makes sense.
Exactly. And then there are sophisticated trade surveillance tools. Tech is huge here,
Ah, using algorithms and stuff?
pretty much. Systems that automatically scan trading data, looking for weird patterns, potential conflicts with the firm's own trades or client interests. Think of it like a high-tech alarm system for dodgy trades.
A digital watchdog. The
Yeah,
article also mentioned disclosure requirements?
right. This often means employees have to disclose all their personal brokerage accounts, sometimes even accounts of spouses or close family.
Wow, really? Family too?
Sometimes, yeah. It gives the firm a fuller picture. Then you have those restricted lists we talked about, blocking trades in sensitive stocks, and periodic attestations.
What are those?
Basically, employees regularly have to formally confirm, like sign off, saying, yes, I followed all the PD rules. It keeps it front of mind.
It sounds like a lot of layers.
Mhm.
And the article also mentioned linking PAD policies to the firm's code of ethics. Why is that link important?
Oh, that's absolutely vital.
Yeah.
Because it frames PAD not just as a compliance task, some rules you have to follow,
Right.
but as part of the firm's fundamental ethical standards.
Yeah.
It helps build a culture where transparency and accountability are just, well, how things are done. It says, this is who we are, this is how we operate.
That makes total sense because you can have the best rule book in the world, but if people don't actually buy into the principles behind it.
Exactly. The rules become much less effective. Which brings us neatly to the human element, doesn't it? Training and culture.
Yeah. Policies on paper aren't enough.
Not at all. You need ongoing, really good training, making sure everyone truly understands the risks of personal trading, what their specific responsibilities are.
So what should that training cover specifically?
Things like what actually is market abuse? What are the exact steps for disclosure or getting pre-trade approval? What happens if you break the rules? And crucially, why protecting confidential information is so incredibly important.
So it's not just don't do this, but here's why it matters and here's the potential damage.
Precisely. And alongside that, you have to build an ethical culture. That means creating an environment where doing the right thing is normal, expected, where dodgy behavior is frowned upon, and importantly, where people feel safe to raise concerns, to report potential problems early without worrying about backlash.
So weaving ethics into the fabric of the place.
That's the goal, embedding it in everyday decisions.
Okay. So if we try and sort of nail this down,
Yeah.
it really sounds like managing personal account dealing effectively isn't just some internal admin headache for banks.
No, far from it.
It seems absolutely crucial for, well, the health and integrity of the whole financial system, for maintaining public trust in the markets.
That's a perfect summary. It's about keeping the playing field level,
Yeah.
right? Preventing people with privileged access from getting an unfair edge over everyone else.
Yeah.
So how firms handle PAD, it really does have a direct impact on the wider financial world
Yeah.
and how much confidence we all have in it.
This has been, yeah, really insightful. And it does make you think, doesn't it? Markets change so fast, technology keeps racing ahead. How will the risks around PAD and the ways firms manage them need to adapt in the future? How do we make sure market integrity keeps pace? Definitely something to ponder after we finish up today.